Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed. At the same time, we have significant space to ease should the labor market unexpectedly weaken.
Clearly, we're at a point where loan growth has just fallen to the very low single digits here. I think we'll get past the deposit cost issue, as Bank of America said, after the second quarter. But, you know, the longer you keep rates here at this level, the more chance you have of not having that soft landing, of having higher credit costs going forward.
We think $3,000 an ounce is in play over the next year or so. And the big driver for that is that we think financial demand for gold is only catching up to what is strong physical. So we think the risk skew right now is still bullish for gold in the medium term as financial macro factors will catch up to what has been strong physical that has supported the gold market over the past year.
We've got 1 hour to go until the market close. Let's take a look at the major averages and how we got here. Well, in the case of the Dow here, quite a lot of volatility. And that's as we heard Jay Powell speaking at an event in Canada, among other things, really seeming to confirm the view that the Fed is going to have to wait a little bit to get more of that good data he referred to last month in order to make any kind of move on rates. This is not significantly different than what we've seen being expressed and heard being expressed by other Fed officials as well. If you look at the S&P, similarly here, a lot of bouncing up and around above and below the zero line, and Nasdaq as well. Right now, it's up about 0.3%. Now, as we watch stocks, we have continued to watch what's going on in the bond market very closely as well. We earlier had the 2-year yield pushing above 5%, the 10-year yield pushing higher again today at 4.65%. So, of course, that is interplaying with what's going on in the equity market. We've been watching Bitcoin go modestly lower at the moment, but it too has been volatile today. And then finally, taking a look at Brent there, up about 0.1% right now. But again, this volatility that we've been seeing, this bouncing around in equities and other asset classes. Just quickly here, as we look at the groups that are on the move today, you've got tech and healthcare that are doing the best. We're going to get to some individual movers in some of those groups later. Real estate, the worst performing group here, that has to do with what's going on with the yield, and because they tend to put pressure on real estate firms that hold a lot of debt. That is the worst performing group here year to date as we have seen those yields push higher. Josh?
All right, Julie. The International Monetary Fund is out with the latest updates to its world economic outlook. For more on this, let's get to Yahoo Finance's Jennifer Schonberger, who is live from the IMF's spring meeting. Jennifer.
Thanks, Josh. The IMF expects global economic growth to remain resilient this year, expanding at 3.2%, on par with what we saw last year. Still, that is below historical averages that we've seen over the past years. Looking at the medium-term prospects for growth, those are expected to be the lowest in decades. Joining me now is Geeta Gopinath, First Deputy Managing Director of the IMF. Geeta, thank you so much for sitting down with me.
It's a pleasure to join you, Jennifer.
As we just mentioned, prospects for the medium term for global growth remain the lowest in decades. That's owed to lower productivity. Why do you see productivity remaining so low over the coming years? And can AI be a game changer for that?
So growth has been slowing since the early 2000s. It's first started for advanced economies, and then we saw that after the great financial crisis, we saw it for emerging and developing countries. And if you look at the main drivers of it, productivity growth, weak productivity growth explains about over 50% of that decline in growth. Another factor is aging demographics and declining working age population. That plays an important role too. And a third factor is just overall investment is weaker than it was before the GFC. And so that's playing an important part. Why is productivity growth so low? I mean, one of the big factors is what we call misallocation of resources, which is if you look at the way labor and capital has been allocated across firms within sectors, that has not been very efficient, and that has played a role in keeping productivity growth weak. Now, what do we need to solve this? Of course, we need to be able to take out all kinds of restrictions on product markets and labor markets that generate this misallocation. But we need more than that. We need new kinds of technological innovation. Now, AI has the potential. It is promising. I think there's a lot of uncertainty, though, in terms of what could happen in terms of productivity growth. The range of estimates are wide. The early estimates seem to, when you look at certain firms that have used it, you're seeing some positive outcomes, but I think it's too early to say. It has promised, but it's too early to say that that's the solution.
All right, moving on, I want to ask you about your outlook for global inflation, because the IMF sees global inflation continuing to decline this year, falling to about 5.9%. But now that Iran has attacked Israel, it raises the risk for a burgeoning conflict in the Middle East. And just today, we heard Treasury Secretary Yellen warn that the U.S. is going to put forth more sanctions on Iran, perhaps on Iranian oil exports. So how does that change your outlook possibly for global inflation this year, as well as the potential for spillovers for global growth?
Developments in the Middle East are going to have important implications for the world. As of now, we are not in the space where the conflict has gotten to a point where we could see oil prices shooting up by a lot. It's not there yet, and we already see that in terms of commodity price markets. You're not seeing much movement over there. It does depend a whole lot on how much, and if we have a big escalation, and that's the uncertainty. Now, we do have sources of supply that can make up, for instance, if there is a disruption in oil coming out of Iran. I mean, there is the OPEC Plus, but there's also U.S. shale. So there are alternative sources of supply that can make up for it. But again, we just have to wait and see how this develops.
Depending on the outlook for global inflation, if it does hold your initial forecast, you do expect central banks to begin cutting rates in the second half of this year. Many expect the European Central Bank to begin cutting rates in June. Is that your expectation as well? And what are the implications for the ECB cutting rates before the U.S. Federal Reserve?
So inflation has been coming down really well in the euro area. Now, the economy is also in a weaker place than, say, compared to the U.S. Now, if the data holds up the way we expect it will, then we can see that there's absolutely good ground for having a rate cut by the ECB in June. Now, what we are seeing is U.S. inflation seems to be holding up a little more stubbornly than in the euro area. That could cause the Fed to wait. I mean, it would be prudent to wait to bring in, before you start an easing cycle in the U.S. So there could be that asynchronicity. But, we don't really see that as having big implications for the ECB in terms of the June rate cut decision.
You mentioned the U.S. Federal Reserve, the fact that inflation has been stickier in the first quarter of this year. Fed Chair Jay Powell just said this afternoon he needs to see more data to feel more confident before he can begin cutting rates. Given the economic picture here in the U.S., do you see the Fed cutting rates at all this year? Should they cut rates this year?
The U.S. economy, in terms of its growth, has exceeded even our anybody's most optimistic expectations. It's been a very strong economy. But that said, we are seeing signs of softening labor market, and wage growth is coming down. We have seen a huge amount of disinflation that came last year as goods inflation came down and energy prices came down. So as of now, we expect to continue to see inflation declining. Now, we've always said that this year was going to be tougher than last year. This year, it's the last mile. It is going to be bumpy, and we have seen those bumps. But we continue to believe that inflation will come down. It may take somewhat longer, but we're in the path to getting it down back to target. What does this mean? This means in terms of monetary policies, that it will be prudent to wait and see how the data comes in over the next months before deciding whether to ease or not.
In the report, it noted 3 rate cuts by the fourth quarter. Do you really think that we could see 3 rate cuts this year in the United States?
So when we make our projections, we have to make assumptions on what's going to happen to the interest rate path. And in this particular case, it was using the Fed's dot plot. I would say as of now, given the most recent data that we have seen, that, that this process could take longer. So, it may not be as many cuts. It may start later. And again, this is an economy that is doing very well. It's a strong economy, and the central bank can wait to see how inflation plays out.
Switching gears, I want to ask you about trade and fragmentation. In the aftermath of the pandemic, we've seen supply chains reconfigured. In the aftermath of the Russia-Ukraine war, we've seen a reweighting of trade relations. How has that impacted global growth as well as the outlook for global growth?
So we're at the early stages in terms of what's happening in global trade and even in global foreign direct investment. We are seeing a rerouting of trade channels. China used to be one of the biggest trading partners of the U.S. That's not the case anymore. Mexico plays a bigger role. We're seeing supply chains stretch. Goods that used to come directly from China now go through Vietnam or go through Mexico. All of this adds cost and therefore has implications for the prices at which we buy things. But still, it's early days. And that's why we remind everybody that there is still time to make sure that we don't end up with a severe fragmentation in the global economy. Because if we do that, then you just throw out all the benefits we have of global trade, including living in an environment with low inflationary pressures.
Former President Trump, now candidate Trump, has put forth the idea of slapping 10% tariffs on all U.S. exports, 60% on Chinese imports. If that plan were to be implemented, what impact could that have on global trade patterns, on trade relations globally? Would we see a step back?
So we wait to be sure about what governments plan to do in terms of their policies before we comment on that. So I think I would hold off on that particular question. But we are in an environment where we're seeing decoupling in trade across different trading partners. And then all of that adds costs to households, it adds costs to firms. It remains our argument that for the U.S. to be competitive, that's the goal, of course, is to have strong, well-trained labor force, making sure that it keeps up with the technological developments that are happening in the world. All of that can help. Strong infrastructure. That just helps making the U.S. competitive and productive. The U.S. actually is doing very well on the productivity right now. In fact, compared to, say, Europe, U.S. productivity growth is strong. So it is a strong economy, and that's going to be the basis for U.S. competitiveness globally, too.
I want to ask you about China, because you see growth slowing this year and next. Certainly, there has been some strain in terms of U.S.-Chinese relations in the aftermath of tariffs that were put on in 2017. Now those relations seem to be easing a bit, thawing a bit. But given the trajectory of growth, where is China's economy now? Is China's economy on the decline?
So we just got the first quarter GDP numbers for China, and that came in over 5% growth for this first quarter, which was more than we were expecting. So we are seeing more resilience in China's economy, and it's a pretty broad-based expansion. We've seen it in consumption, we're seeing it in exports. So it is broad-based. Now, that said, China does have some important issues to deal with, including the health of its property sector. That is weak. That's a correction that's been happening now for a couple of years. It's not completed, and we are still seeing weak investment over there. Secondly, we still have weak consumer confidence. It is an economy where we do believe the government can help by providing more income to low-income households, because that can help with consumption spending. Stronger social safety nets can help bring up demand. It is an area where a lot more work can be done. I think China needs to be able to bring up its demand, given the amount of supply that it has produced, so that it can raise its productivity and its growth rates.
Geeta, thank you so much for your insight. I so appreciate it. Hope to speak with you again soon.
Thank you.
That's Geeta Gopinath, First Deputy Managing Director of the IMF. You're watching Yahoo Finance. We'll be right back after this.
Stocks higher heading into the close after Federal Reserve Chair Jerome Powell said it will take longer than expected to get inflation down to the central bank's 2% target, meaning it's likely going to take longer to cut rates. Joining us now is George Goncalves, MUFG head of U.S. Macro Strategy. George, it's great to see you. It's been a while since we have chatted. And I'm curious what you made of Powell's comments today. If it's like sort of he's confirming what we already know, or do you think that is indeed notable that he did sort of confirm this view that the market already seems to have come to?
Look, well, the market's been kind of dragged here too, and obviously great to see you as well, and good to be on. This has been a market that's been fighting the Fed for so long that it's in this process of kind of giving up, and in many ways, in doing so, is doing the tightening for the Fed. We had a pretty big rise in long-term rates. It's long-term rates that matter more at this point. The Fed's not going to hike, most likely not going to hike, and so at this point, it's more about can rates normalize. And by doing so, that's like introducing tightening. So, I mean, like I don't think we've learned terribly a lot from today's conversation with Chair Powell, but it does confirm that they need confidence, and they really are lacking right there.
George, I'm interested to get your take on just when you think about the trajectory of inflation over this year, George, what does it look like to you?
I mean, look, we are in that camp that it is a bumpy move towards lower inflation. Nothing's ever linear in life, and that's including the markets as well as an inflation process. I mean, it's complicated, right? You have demand forces, you have supply forces, sometimes going in the same direction or in opposite directions, and we are, at that risk of like supply constraints adding to inflation, and this really creates a big challenge for the Fed and for market participants all around. That should we look through this temporary inflation, because you can't use the word transitory because you know what that means. And so like it's a real big challenge to understand where we are in the cycle. I think it's heading lower. It's not going to be a straight line, and it's going to really frustrate both policymakers and markets alike.
Well, and we've had a number of people say to us the Fed wants to get on with it, right? They want to be able to cut here. The calendar, though, could prove a little challenging for the Fed, right? Because you have the June and July meetings. Then you've got a September meeting, which is going to be in the thick of presidential and congressional campaign season. And then you've got a meeting right after the election. So if they don't cut in June and July, would it even be possible to make a move at that September meeting?
That's a great point. And that's really why my view has been more nuanced, which is, does 25 basis points really matter? I mean, like, let's be honest, like 25 bips is not going to change things that much. And it gives them like a down payment towards their easing, which they want to do. I mean, they have it in their forecast. They know they're restrictive, and they don't want to create any sort of like undue harm to the economy down the road. But if you miss the June, July window, and the only reason you would cut in September is if something progressively gets worse, right? So that's a kind of the irony here. Like, it's almost better to go early and then skip a meeting like September, and then wait for the election and then go again if you need be. But if you wait until September, the only reason why they'll cut in September is because something's gone wrong with the data or in the market somewhere.
And switching gears, George, a bit, another topic front and center for investors right now is geopolitical risk. We don't know what the Israeli response to the Iranian strike over the weekend will be, George, but just as a strategist, walk me through how you're thinking about geopolitical risk right now.
Look, it's the tail risk that you have to be mindful of, and you need to incorporate that into your thought process, as well as like what sizing of trades and ideas makes sense in this sort of environment. So it is playing a crucial role, and I'm sure it's one of the reasons why there's some trepidation amongst traders and investors to not really be fully allocated with whatever view you may have, because you just don't know. It can go in either direction, and even if you think you know the outcome, the market might respond completely in a different direction. So I think the geopolitical thing is an important aspect for really the three channels that I focus on the most, which is like long-term interest rates, which could be linked to oil, what's going on with oil by itself, and then the dollar. I mean, those three things will dictate how I think markets will perform over the next 2 to 3 months. And again, we don't have any clarity or certainty what's coming out of the Middle East for sure.
George, I'm also curious what you make of a view that is gaining a little bit of traction that was once sort of anathema on Wall Street, more common in places like Turkey, oddly, that by keeping rates, by keeping policy quote unquote tight, that the Fed has actually kept the economy hot because people have so much income right now because of those high rates, keeping money in things like money market funds, that they've had more money to spend. What do you make of that view?
So that to me is more of a narrative to justify what's happening than an actual reality, in the sense that, and this is the big problem which we've always had all throughout. It's a bifurcated economy. Sure, those that have large cash balances, either institutional or high net worth, yeah, they're probably building up cash balances. Now the question is, are they consuming that cash balances or just sitting on it? Number one. Meanwhile, on the other side of the spectrum, you have 80% of the population who are actually feeling the brunt of higher rates. And so it's a very bifurcated economy that the rates channel is disproportionately impacting lower income versus upper income. So yes, is it working? Is it enough to keep the economy going? I don't think so.
George, thanks for joining the show today. Appreciate your time.
My pleasure.
Checking in on some of today's top analyst calls. Jefferies downgrading Hims and Hers Health to hold and lowering its price target to $15. So this one, Julie, team at Jefferies, they downgrade the stock, and basically their point is, listen, they say expectations now at a more appropriate level, in their words. The analyst saying execution, he says, has been stellar here. Says the company has generated impressive revenue growth, though emphasizing growth is slowing. He says it seems just in large part he thinks that's due to just the large of law numbers kicking in. Say expectations have now caught up to reality, limiting potential upside to numbers.
Right. On that last point, basically the analysts looked at past history, and going into earnings, they said estimates have tended to be low. And so it's an unusual situation that estimates are already in line sort of with what this particular analyst thinks is going to happen with the company. And that the analyst, by the way, is Glenn Santangelo. The other interesting thing I thought about this call is that, Hims and Hers is basically effectively a new age mail order pharmaceutical business, right? It's an online pharmaceutical business.
Hair loss, dermatology,
right,
behavioral health. Yeah.
Exactly. Hair loss and erectile dysfunction, which the analyst points to as the two most successful areas for the company, are sort of uniquely suited to, I get my prescription online, I meet with the doctor online, because those are, potentially people like to keep them quiet. And he's questioning whether there is a big potential for other categories that are so perfectly suited to what Hims and Hers does, which I think is interesting because it's a more existential question for the company than just sort of the quarterly by quarterly
to your point,
trends.
he points out that they have expanded to new kind of therapeutic kind of categories, he points out, but he's just, I guess he's saying, the incremental unicorn categories to him, less obvious moving ahead.
Right. I just thought it was kind of interesting here. Also interesting, Apple shares are sliding today. Needham, Laura Martin over there, coming out with a note lowering estimates for the tech giant amid iPhone sales concerns and weakness in China. Now, this is something that has gotten a lot of attention recently from the street here. The shares are down another 1.6% today, and basically, this is sort of an acknowledgement of what's been out there, that there's concern about iPhone sales and weakness in China. However, Laura Martin also saying it's offset a little bit by slightly higher revenues than previously expected for iPads and Macs. But that said, she is cutting these estimates.
Yeah, she remains bullish, right? And she didn't change her price target either. It's 220. But she just, in her words, she says Apple's anemic or negative growth outlook and expected cost increases to fund Gen AI, she says it's preventing new investors from stepping in at these levels even though as the stock is down about 12% now, Julie, this year. It's been hit. Another round of bank earnings out this morning. We're going to discuss what results from Bank of America, Morgan Stanley, and others mean for the broader sector. It's coming up next. More bank earnings coming in today with mixed results. We heard from Bank of America and Morgan Stanley. Our next guest says there are still headwinds the industry has to wade through, and he favors bigger, more business diverse banks. Here with us now to break down the latest bank earnings is David Ellison, portfolio manager of the Hennessy Large and Small Cap Financial Funds. David, it is great to have you on the show. So maybe let's just dive right in, David, to some of these names. Morgan Stanley, they reported investors seem pleased. Walk us through the results, David. What'd you make of them?
Well, the investment banking has been good across the industry, and they had a good investment banking, sales and trading quarter. Asset management continues to do reasonably well. Obviously, the market's been making new highs, and so the flows and the assets should follow that at Morgan Stanley. So I think it's also one that's less sensitive to what's happening with traditional banking, yield curve, credit. Absolute level of rates don't impact them as much. So I think it becomes something to kind of hang out in while you're waiting for the resolution on some of these other headwinds that aren't impacting Morgan Stanley.
Yeah, I mean, we saw that really reflected in the other big banks that do have both sides of that business, right? Goldman doing better, more in the Morgan Stanley category. Then you have Bank of America reporting today, the sort of trading and asset management side of the business doing well, like it did at many of the banks, but higher credit card charge-offs, which reflects the more consumer challenges that are out there right now. How long are we in for that at the banks, that sort of delicate balancing act?
Yeah, well, I think the operative word they're using now is credit is normalizing, which is code for non-performers are rising. And they're rising pretty much across the board, not very fast, at least for the ones that have already reported. And so I think that will continue just because that's what happens when these cycles start, it seems like. And obviously you got to watch it. Everybody's worried about commercial real estate, office, et cetera. Everybody knows about that, but it's still going to be an issue. So I think they've got to wade through that. I don't worry about that much because everybody knows about credit. Everybody's dealt with credit for a long time. I've been doing this for 40 years. We've had credit cycles. I think the boogeyman or the real new issue is what's going to happen to the deposit side. Because since sort of the Silicon Valley, First Republic issues of a year or so ago, the deposit side has really been exposed as a risk factor for the industry that we've never had. So you see most of these large banks losing non-interest-bearing deposits to the market. And I'm not sure where they're going or where they're ending up, but that really is the golden goose of this industry, are these low-cost deposits that they can fund reasonably low-risk loans with and make a decent return over time, lever it up and do okay. And that covers a lot of sins with some of the other more risky stuff they do. But if they continue to lose that, that's going to be a long-term problem for them in terms of margins and overall profitability. So if I worry about anything now going forward, it's going to be what's going to happen to those deposits and what are those deposits going to cost them long-term.
Can I ask you, David, kind of as you look across your coverage universe, is there one bank you're more bullish on than others? Do you have a top pick?
Well, I like J.P. Morgan. I think that's one's easy to own. It's the best in class in all of its, it sort of owns the waterfront property and all of the areas where it does business. I like Citicorp because it's the cheaper one. Again, Citicorp and J.P. Morgan roughly have the same book value. One's trading at 60 and one's trading at 180. So clearly there's a valuation gap there. On a price to book basis. And if Citi can do anything right or anything better the next couple of years, the stock will close that gap. And so I think that's the opportunity there. So you've got the good and the bad, or the good and the one that's been bad that can get better. So those are the two that I think are the most interesting. Everybody else is kind of in between. Again, all these companies are kind of swimming in the same pool. They've got roughly the same assets. They've got roughly the same cost of funds. And it's all about management and managing that balance sheet. So, it's a homogenous industry more so than it used to be, which is why you see them all trade together. most of the time.
David, we talk with a lot of investors about when the Fed is going to cut interest rates, right? And I think some have made the argument that if you're talking on a macro level, a stock-wide level, the timing doesn't necessarily matter as much. It probably matters to the banks, right? And so as you think about when the Fed is going to begin to cut, how much of a difference is that going to make in the earnings of these banks, especially when we're not getting increases in net interest income forecasts?
Yeah, well, again, I think we're not getting increases in net interest income as much as we'd like because we're losing those core deposits. And that's really hurting them, although it doesn't show up as much as maybe it will over time. But I do think, again, this is an industry that is impacted by rates. Microsoft is not, NVIDIA is not, Google's not, but the banks are, and the yield curve's been in a negative position for a long time. I think it's the second longest in history, at least if you go back as far as maybe you want to go. But so the industry has been struggling with that, and the Fed controls that. And I think that's, unfortunately, that's part of the problem with the industry is that they're exposed and sensitive to macro issues that are controlled by government entities that may or may not care about how they're doing. And I think you saw that in the last 18 months with Silicon Valley and First Republic and so on and so forth. When they fail, the market doesn't care and the Feds don't care. They just merge them into other banks and move on. So we're in a different environment now from a rate point of view, from a regulatory point of view. If there are more failures, the banks don't care. And if you go back to 2008, they cared because the big banks were in trouble. And so they had the ear of the regulators and the guys at the top of the food chain. The little guys do not. And so nobody cares about them. And if they continue to fail, it's actually good for somebody like JP Morgan, who has benefited mightily from the First Republic deal. And so I think the industry is bifurcating. The big guys matter, the little guys don't, and you should invest accordingly.
Yeah, quite a different picture than in 2008, most definitely. David, thank you so much. Great to see you. Well, it's time now for some of the day's top trending tickers as we approach the end of the trading session. We're going to take a look at shares of United Health Group, first of all. That stock rising in today's session after beating revenue estimates in the first quarter, despite financial impacts from that cyber attack on its subsidiary Change Healthcare. Our Anjali Kamlani is joining us now to discuss. This was what everybody was watching, although there's some other interesting stuff in there, but Change Healthcare was the important
story.
thing.
Yeah, we have to focus on that because that is the story. Everyone's surprised that the company did as well as it did despite the attack. The numbers, if you look at them, $872 million is the total impact that the company recorded for the quarter. And it's estimating that the full year impact is going to be $1 billion. Now, that's a lot of money. However, if you take it into context of the reported 2024 expected revenue for the company, that's $400 billion, it's a drop in the bucket. And that is what, some had cautioned that while we do see from the attack just how much this company has control of the financial pipelines of the healthcare ecosystem, it is also important to note that it is such a large company that it itself is not going to be impacted as much. However, we do know the larger impacts that the company had on pharmacists, on providers, and the like that were struggling and continue to, in some cases, with lack of payment. So we did see that extra payment out to and the loans that United is responsible for these providers. So that has been helping, and that is where that excess spend comes from that they incurred in that quarter.
All right, Anj, thanks so much. Appreciate it. Moving on, Adidas shares getting a boost after the company posts upbeat guidance following its preliminary results for the first quarter of 2024. So that was the story here, raising guidance, Julie, specifically its profit target for the year. They're now looking to generate an operating profit of about $743 million. That was up from the previous target. And it sounds like that can basically be pinned on demand for classic sneakers and sales of what remains of its stockpile of Yeezy footwear, too.
Yeah, that's something that they've been trying to work down. There was a commentary from Anisha Sherman over at Bernstein, who covers the stock, and she said Yeezy did help, but it didn't drive the beat. To your point, it was more a resurgence that we have seen in demand for Sambas and some of those other classic sneakers here. And she also says management really emphasized that Yeezy was not what was contributing here. What's also interesting is that This result comes a day after we got an upgrade from Morgan Stanley, a double upgrade, in fact, to overweight from the stock, saying that growth in top line momentum was seen outweighing risks to the equity story. The stock is up about 22% from its low back in November, but it's still down pretty sharply from where it was back in 2021, its most recent high.
Yeah, last year, I mean, obviously it was challenging. Net sales fell. They canceled that partnership with Yeezy namesake Kanye West. The company has said they intend to return to growth this year. Mm-hmm. They did, though, call out unfavorable currency effects, and how that's going to probably impact profitability this year. So one to watch.
There is another trending ticker that we have to mention, not a frequent appearance on our trending ticker list, but it's Hawaiian Electric. Those shares are trading at a 40-year low. That's ahead of an expected after-action report, as it's called, from the Maui Fire Department, detailing how the agency responded to those devastating Maui fires. Now, according to a report from Bloomberg, the findings show first responders were not to blame, which raises concerns about what kind of liability Hawaiian Electric might face here. There is also an attorney general first phase of an investigation that's slated to be released tomorrow. So there's anticipation of that as well.
Yeah, the utility is just dealing with these lawsuits alleging, listen, the power lines caused the fires, right. That the company didn't maintain its power grid during the storm that caused the deadly fires, and the stock down today, now down about 35% already this year.
Yeah, so we'll keep an eye out for that report. And homebuilder stocks, we're watching those as well today. They're under pressure on weaker than expected housing starts data. Our Danny Romero, who tracks housing for us, is here with the details on that.
Investors aren't too happy right now, especially what's going on in the home building sector. If we take a look at home builder stocks, they're down today. Lennar is down about 2%, D.R. Horton as well, down 2%, and also the index that tracks the performance on home construction, ticker ITB, that is significantly underperforming the broader market today. And this is all on the heels of the fresh government data that we got. Housing starts were down 14% on a monthly basis, but single family starts actually took a bigger hit on a monthly basis. They're down 12%, but on a yearly basis, they're up 21%. But remember, March was a wet weather month. I mean, I can contest to this being in New York. It rained a lot in March. Mm-hmm. So that does slow down construction, obviously. But another thing to factor into all of this is home builder confidence was also flat in April. So that doesn't look too great right now.
And Danny, we're going to start getting earnings reports for some of these names. D.R. Horton on tap this week, right? What do you expect to hear?
So home builder season, earnings season is kicking into gear. D.R. Horton on deck. They report their second quarter earnings before the bell on Thursday. But some analysts on Wall Street, they're really saying that the interest rate uncertainty really could hit home builders and their forecast for this year. Other analysts are also expecting financials to be really solid, but gross margin outlooks could be uncertain. Because remember, mortgage rates right now, they're currently hovering around that 7%. And these builders have been offering these really nice incentives of mortgage rate buy downs. So that does weigh very heavily on gross margins. So that will really be something that I'll be looking out for, especially when it comes to finishing off this first year and this whole rate debate that's going on.
Yeah, we'll be watching those numbers. Thanks, Danny. Well, gold is trading near record highs, and Citigroup says the precious metal has much more room to run in the months ahead. We'll take a closer look at the rally in our investor playbook next. Mining company Barrick Gold delivering lower production numbers and rising costs in its preliminary first quarter results. Those shares trading lower by 5%. They are also trending on Yahoo Finance here. So these production numbers indeed coming in a little bit lower than anticipated. Copper production also was missed expectations, it sounds like, by a bigger margin here. And so that's responsible for the drop that we're seeing here. Gold production coming in, the company said, at 940,000 ounces. That's for the first quarter. The estimate was for about 978,000. So decent sized miss there.
Yeah, just looking at some of the commentary, analysts at Canaccord, they like Barrick, recommended to their clients. And their point was, Julie, yes, production was kind of slightly negative. Gold, copper production came in below. They do know Barrick expects production to progressively increase throughout the year with declining costs. Stock has not been working. It is well in the red this year and over the last 12 months, though most on the street who cover it still like it.
Well, and that's in sharp contrast to the underlying metals, right? We've seen increases in gold. We've seen a bounce in copper here. So it's interesting to see Barrick underperforming what's going on in the underlying metal. But let's talk about that a little more, shall we? Indeed. Gold has been on a tear as of late. It's been driven by geopolitical tensions and the bullion safe haven appeal. Citigroup, the latest in a lineup of Wall Street banks to upgrade its forecast for the precious metals price. We're going to look at how to navigate the big picture with the Yahoo Finance playbook. I'm joined by John Ciampaglia, Sprott Asset Management CEO and Sprott Inc. Senior Managing Partner, and Will Ryan, Granite Shares founder and CEO. Guys, thanks so much for being here. John, I want to ask you, first of all, what you think the primary drivers of gold's march upward have been. Because, yes, there has been geopolitical tensions, but it's also been confounding to some in the market that we have seen the magnitude of strength that we have seen.
Yeah, thanks for having me. Well, I would say it really came out of its slumber back in late last year when the Fed clearly signaled that the pivot is underway. That has obviously been positive for gold, as it does compete with other interest-bearing investments. But I would say the other more macro factor that's been driving gold over the last year and a half has actually been very steady buying by central banks around the gold, as they're basically diversifying away from US dollars as part of their overall foreign exchange mix. And China is really the leader there. They are buying record amounts of gold every month. And I think this is part of a de-dollarization strategy that they have. Now, other central banks are also following suit. Turkey, Singapore, Poland, India, they've all been big buyers of gold. And even Chinese retail investors, as they've kind of run away from the property market, which is blown up there, and the stock market hasn't really worked out. They're going back to traditional cultural stores of value, which is gold. So I think all these things have helped gold kind of wake up over the last 6-7 months.
Will, I want to bring you in here as well and just get your take, if you agree with John about just kind of the fundamental drivers here, Will, and also just where you think gold is headed from here. Citigroup, I think they recently said, Will, they think gold's going to set to reach 3,000 an ounce over the next 6 to 18 months. That sound reasonable to you?
Yeah, so I agree with a lot of what John's saying. I think just to add into that, what we've seen is there's some very large options positions in the market, so upside strikes of 2,500 upwards and certainly 3,000, which is also kind of another factor to add into this mix. But more broadly, could the price of gold go to 3,000 or higher this year? I think given the strength that we've seen and given the macro factors that John's talking about, I think that if we see some further, unfortunately, unstable, unrest in the Middle East, I think that could be possible.
And so, Will, if that's the case, if it's going to go higher, what is the best way to play it here? Is it to buy gold itself? Is it to try and play it through the miners, which have lagged? Which way would you sort of look at?
Well, I mean, call me biased, but I obviously run a large gold ETF, so I'd say the best way to play it is through the gold ETFs, which give you the direct price exposure, obviously. So very simply, if the price of gold goes up by 10%, if you buy a physical gold ETF, it goes up by 10% also, less the prorated fees. So it's an extremely efficient way to do it. And one of the reasons why the miners are lagging, clearly not every miner is in this position, but it's the same as that we've seen in previous cycles where it's difficult for these companies to handle these inflationary costs. And that's just something that, as the gold price goes up, other vendors and other parts of the supply chain raise prices, and it's difficult for companies to manage that. If you contrast that to, it might be a silly example, but in something like the crypto world where you have the price of Bitcoin going to all-time highs, look at also the stocks like Coinbase performing incredibly well because they don't have the same kind of inflationary costs that you deal with in the real world, the mining sector.
John, bring you here, and same question to you, John. Viewers who are listening right now, they want exposure to gold. What would you recommend, John?
Yeah, well, we obviously are managing about $10 billion of physical gold on behalf of our clients, so we're big proponents. And gold has very unique attributes for a portfolio. It often acts as kind of a safe haven asset and ballast against traditional stocks and bonds in periods of unrest. And the world obviously has been more unsettled the last couple of years between trade wars and whatnot. And that's one of the reasons why people own gold in their portfolio. As you started off at the beginning of the segment, gold stocks are very different. They're different animals. They're stocks, and so they tend to have correlation to overall the stock market. But they also, they obviously have their own specific issues in terms of their production at their mines. And as Will said, inflation in all industries has been very intense the last few years. Mining has not been spared in terms of key inputs and labor costs. That has eroded some of their profitability over the years. But as this price of gold breaks out into new highs, that is obviously going to help them going forward. And I think that's why the gold stocks are performing a little better. We're not seeing widespread interest right now in terms of institutional investors chasing the momentum. And we think that if institutional investors return to gold, that could really act as a powerful catalyst to get to further new highs in the coming months.
How much of it is it a risk, and Will, I'll take this one back to you, that the Fed doesn't start to cut rates, right? Because traditionally, higher rates have not been great news for gold, although perhaps anticipation of lower rates have helped fuel some of it this time, as well as that physical buying that you both have talked about. But Will, if the Fed doesn't cut, how much momentum can gold keep up?
I think it's a risk, but to me, it's more of a risk in the short term, because then the question or the natural extension of that is, well, what is the risk of them not cutting rates? And to me, the risk of not cutting is greater than cutting. So to me, it just kicks the can down the road, so to speak, and we end up perhaps with bigger problems. And to John's point, I think the missing piece here for the gold market is this big influx of investment dollars that we typically see. And obviously in 2020, we saw when gold hit an all-time high. And the difference between now and then is we just don't have this fear premium in the market that we had back in 2020. And yes, of course, over the weekend, with the Iranian strikes on Israel, we've seen the gold price recover from the sell-off on Friday. And regain that strength and inject a bit of fear where some of the risk assets fell. But I think for gold to really get materially higher from here, we need that fear premium to come back into the market in a way that we've seen in the past. And that's really what motivates investors more than anything. So to me, it's a stock market dislocation is a breakdown because of perhaps policy or geopolitical reasons that sees gold go materially higher from here.
And John, final question to you. I want to get your thoughts about silver. In your opinion, John, is silver poised, set up here to follow gold higher?
Yeah, great question, because we obviously run several silver funds as well. And the typical pattern with silver is gold is the leader, it breaks out first. And then within a few months, silver kind of takes charge and slingshots by. And we're starting to see that. It obviously has a lot more volatility than gold because it's not held by central banks. So buying pressure on silver can really move the price around shortly. But, silver is still way off its all-time highs of, back in 2010. It's incredibly cheap relative to gold. And we see very strong buying coming from India for silver, as well as steady consumption of silver for the use of solar panels, which is being built out at record amounts around the world right now.
John, Will, thank you guys both for joining the show today. Appreciate it.
Thank you.
Well, wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickry to get you up to speed on the action from today's session. And a little bit of a photo finish here for the major averages. As we talked about earlier, the S&P and the Nasdaq at least were bouncing between gains and losses. The Dow holding in the green here, up about 64 points here, about, call it 1/10%. But the S&P 500 actually finishing in the red in the last few moments of the session, down about 1/5%, and the Nasdaq similarly finishing lower just in the last few moments, off by 1/10%. We continue to keep an eye on what's going on in the bond market here, with yields pushing higher to 4.66% on the 10-year, even higher on the shorter end of the curve. And so that's been something a lot of market participants have been paying attention to. And one of the things that's been putting pressure on the market after we heard from Jay Powell today, speaking in comments in a discussion in Canada, and talking about the need to wait for more data in order to start to cut rates. So pushing back the perception of when those rates are going to begin. Jared's got a closer look at today's sector action and how all of that played out.
Thank you, Julie. A data-dependent Fed, who would have thought? I'm looking at the 10-year, and I'm going to get to some heat maps in a second, but I'm glad you pointed out that this is the highest level of the year. In the face of that, really interesting to see which sectors are doing well and which are not. Now, tech, you would not think that's typically what you think of as a growth sector. That was actually number one, although just barely in the green, 0.1% there. Healthcare and staples also green, so that's a defensive setup. Real estate and utilities, those two very interest rate sensitive sectors, those took it on the nose, down over 1%. Usually tech is very interest rate sensitive, but I'm going to show you our semiconductors heat map. That is mainly green. Here's our software heat map, more green than red. Where we get to some red here is unprofitable tech. So this would be in the ARC Innovation holdings there, disruption trade. Just taking a look at our leaders, we do have semiconductors. Just went over those. One of the few bright spots today. We also see momentum, software. I think we did this pretty well. Retail also in the green, but just barely. What did not work today? Solar, ARC components, so that would be what we just went over. Korean stocks, also internet stocks over in China. So for the most part, somewhat of a risk-off day, though not in all sectors.
Thanks a lot, Jared. Appreciate it. Well, as stocks closed the day mixed, our Alexander Canals here with the takeaways from the trading day. And of course, you were paying attention to Chair Powell's comments as well. And obviously, we saw that sort of percolating through the market.
Yeah, markets really continuing to come to terms with this higher for longer interest rate mantra from the Federal Reserve, which Fed Chair Jerome Powell pretty much all but confirmed during his fireside chat earlier today. We did see quite a bit of volatility in equities throughout the day, although, the Dow was able to cling to those gains despite a more hawkish tone from Jerome Powell. But it was really in those treasuries that we saw the biggest moves. The 2-year note briefly touching about 5%, its highest level since November. If you take a look at the 10-year treasury, that is inching closer to 4.7%, which is the next technical level to watch here. And for me and others who've been following Powell and his rhetoric for a bit, it was interesting to see this pivot in his language, how much more clear he was when it comes to the path forward for interest rates and how we are in this higher for longer narrative probably throughout the rest of the year. He said, quote, "The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence." So these comments really pushing investors to reassess their risk appetite given this highly restrictive environment that we're likely to stay in. That's why you saw some of the Homebuilder stocks and those more interest rate sensitive in their areas of the market struggle today as well.
I mean, even so, it wasn't a huge move given that he was sort of acknowledging what the market is already kind of coming to terms with. Everybody keeps telling me to watch the VIX. You're telling me, Josh Schaefer's telling me. Why should we be watching the VIX again?
I've been noticing some interesting moves with the VIX lately, especially after yesterday. The VIX, otherwise known as Wall Street's fear gauge, it's hitting levels that we haven't seen for quite some time. For example, yesterday we saw the VIX close up above 19 for the first time since Halloween. We
are continuing to hover at those levels. We did throughout today, although it did close down closer to 18, but 20 is the level to watch here. That's the next technical level that Wall Street analysts have been talking about. And Citi said the move points to more localized signs of stress in the market as rising yields continue to pressure those stocks, while investors are also digesting escalating tensions in the Middle East and what those rising geopolitical risks could mean to markets. And even market bull Tom Lee from Fundstrat, he said the surging VIX means investors don't believe that the worst is yet to come and that you need to be a little more cautious when buying any type of dip. So just something to keep in mind and to watch there as we're seeing these levels oscillate and get closer to that 20.
All right, Alec Canal, thank you. Appreciate it. Oh, we got some earnings to get to, Julie. United Airlines reporting, and they're popping here in the after hours. Let's get to the numbers. Adjusted loss, 15 cents per share versus it looks like an estimated loss of 57 cents. Operating revenue clocks in at $12.54 billion. The estimate was $12.44 billion, so better there than expected. Cost revenue impact from MAX 9 groundings, $200 million. So they are breaking that out and putting more color on that. Double-digit percentage boost in business demand, they call out, as well as saying demand environment remains strong. So initially, remember, this stock was flat year-to-date heading into this print, but it's actually down more than 10% since early April. But you can see a nice pop here, at least initially, in the after hours.
Yeah, it's interesting because the company came out back in January when it first gave us some details around what this situation was going to cost. At that time, it said the loss would be 35 and 85 cents. Mm-hmm. So it obviously was better than the range that it itself provided, let alone what analysts have been anticipating. So we'll wait for the call to see exactly why that is, that it wasn't as bad as had been feared here. How did they manage the costs around the grounding of those planes? I think that is going to be the main question here. If you look at passenger revenue per available seat mile, which is one of the important metrics for the airlines, it came in at 15.79 cents, which is also a little bit above estimates and up 1% year over year. So they were able to get higher revenue per passenger, not hugely higher, only 1% higher year over year, but still a little bit higher. So that perhaps contributed to it as well. And the revenue, the overall passenger miles flown was up 9.3%. So reflecting what we've heard from some of the other airlines, particularly Delta, that there was still demand, certainly. It's just a question, in the case of United, of whether it's able to meet that demand because of the grounding of some of these planes.
Yeah, another big question for sure in the call, Joy, is going to be regulators. I mean, the FAA increasing oversight after this series of really just kind of headline-making mishaps, and so I think investors of the street are going to be looking for any kind of color insight about that safety audit.
Okay, let's move on and broaden it out again, talk about what's going on with the Fed. No cuts till Christmas, or as I kept hearing in my head all day, no cuts till Christmas. I don't know.
I get it, Julie.
Our next guest thinks that after a string of hotter than expected inflation reports. For more, we're talking to Blake Gwynn, head of U.S. rate strategy at RBC Capital Markets. Is that the song you had in your head?
That's what I was going for. That's perfect. Yeah,
yes, I'm glad we were on the same page with that. So, this is sort of the Bostic view, if you will, that perhaps we'll get a cut in the fourth quarter of this year. That's where we're at today. And do you think that Jay Powell was acknowledging that today?
Yeah, and I think, you said it correctly before. I mean, he's kind of marking to market to some extent. And I think we've already heard a bit of this shift in rhetoric from other Fed speakers since that March CPI print. Collins, Daly, Jefferson today. So some of the other more kind of centrist members and even some of the people that tend to lean dovish, you're seeing them kind of back away from this bump in the road narrative where they were kind of trying to write off the January strength in inflation as idiosyncratic, something that was going to correct, get back to that kind of Q4 2023 trend. But I think we've seen those speakers back away from it, and then Powell basically confirmed that shift today. He didn't try, I think, even once to really kind of sell that January data or the strength that we've seen in Q1 as, a bump in the road.
And are you saying the one cut you're looking for in December, is that just because November, forget it, just too politically sensitive?
Yeah, I mean, that's a big part of it. So, we had originally been at 3 cuts, and I've been a big advocate for the fact that, politics aren't going to play a role in what the Fed decides to do. That was probably more true when they were going to start that process in June. I think there's a big gap between continuing a cutting process that's already in place. I think that's very justifiable to the public, to Congress, to say, hey, we told you there were going to be 3 cuts. We started it in June. We're going every other meeting. It's very defensible. And I think it gets a lot more difficult when you're starting that process right in the heart of the election cycle. And the other thing I would say is that what we've always been talking about is really an adjustment process. It's preventative cuts. This isn't a forced reaction to deterioration in the data or responding to some kind of exogenous geopolitical shock or something. This was preventative. It's a nice to have. It's not a need to have. If that's the case, I think starting it and kicking it off right in the middle of the election, it's bringing a lot of potential heat onto the Fed for no real upside. Because in the end, 25 basis points in September, November, it's not going to be the make or break between a hard landing or a soft landing.
What is, at this point? I mean, if they have kept policy as tight as it has been for as long as it's been now, and it hasn't brought down inflation, and we keep seeing these inflation prints, why is leaving it where it is now going to achieve the goal?
I mean, I think that's a lot of the questions that are being asked. I mean, we put out a piece several months ago just talking about how rate hikes this time haven't really worked the way we thought. And there's some idiosyncratic reasons related to the pandemic. We had this big wave of fiscal support. I think a lot of people, a lot of businesses were able to kind of term out debt, reduce their exposure to interest rates. So, we had very clean balance sheets coming into this. Fiscal policy kind of remains stimulative. So I think there's just a lot of things going on that have kind of dulled the impact that these rate hikes have had. And so I think part of the rethink going on inside the Fed right now is what exactly is a neutral policy rate? Is the rate setting that we currently have, is it as restrictive as they once thought that it would be? I think at least with the data we've seen so far, the answer to that would probably be no.
Okay.
And Blake, just looking at the 10-year here, we backed up to 4.66. Do you think we test that October high of 5%? Where do you think we had kind of near intermediate term?
Yeah, so I still lean against testing that 5% level. I think if you think about where we were in August and September of last year, it's definitely a different place. I mean, we were still pricing in some probability of another hike in the cycle. We had this backdrop of Treasury supply. If you remember, there was a lot of angst about a supply-driven term premium rise. I think that came on the back of that August refunding when Treasury said, hey, deficits, their announcement showed deficits bigger than expected, funding needs bigger than expected. So they were also increasing the size of Treasury auctions. So I think that kind of served as a backdrop. I don't think the supply itself really matters that much. I think it's more that everybody was concerned about the supply at the same time as you had hot data and possibility of a cut. If you look at now, I think what's different is the bar to another cut is very, very high. I think on the supply side, we're starting to see
the bar to another hike.
Bar to another hike. I'm sorry. Thank you. So that is very, very high. I don't think we're really entertaining that. It's not really priced in maybe 20, 30% into markets. I think on the supply side, you're starting to hear some more discussions around that deficit issue, but we do have a refunding announcement in a few weeks. Our expectation, this is going to be a very strong tax season. If anything, I see possibility that deficit expectations are actually marked down. And also, at least in our forecast, and I think Treasury's been fairly clear in communicating this, they're not increasing their coupon auction sizes for some considerable amount of time. So you kind of take that, I think, out of the backdrop, and I do wonder if that refunding is actually going to help kind of cool markets, help settle us into this kind of new higher range without really retesting that high from late last year.
Do you think there's going to be adequate demand for the upcoming auctions? There was a 10-year auction this recently that was a little wobbly.
Yeah, we've had some tails, but overall, I mean, I think even as Treasury has increased all of these auctions, they went on this campaign where they increased auction sizes for multiple quarters. Overall, we've taken it down pretty well. I think you've had some individual auctions that maybe go better or poor, but overall, we've come out of those situations with yields in pretty good shape. One of the worst 30-year auctions I remember, everybody said, oh, this is, it had a huge tail. Everybody said, this is it. We can't take it down. By the end of the week, we were unchanged on 30-year yields. So it's tough for me to really think that that's a huge problem.
Makes sense. Blake, thanks for coming in. Good to see you. Appreciate it. Well, shares of United Airlines are soaring after it reported a far narrower loss per share than expected in first quarter results. We've got more market domination and more analysis of United coming up.
United Airlines results topping first quarter estimates despite a $200 million impact from the temporary Boeing grounding. Airline also noting several adjustments to its long-term fleet strategy. Here for a closer look, let's bring in Peter McNally, Third Bridge Global Sector Lead for Industrials, Materials, and Energy. Peter, it's good to see you. So listen, they report, investors clearly like it. The stock is popping in the after hours. Give us your take on the results, Peter.
Well, I think it comes down to expectations, and they were pretty low. Let's face it, these are some high-profile issues that they faced during the quarter around the Boeing 737 MAX 9. Maybe not quite as bad as those, as those low expectations. But the key thing, or the key things going forward, will be the outlook. And clearly, they're going to get fewer planes than forecast. So we've seen CapEx get cut. Eventually, they're going to spend that money. So instead of $9 billion, it looks like $6.5 billion will be, the number this year, and they'll get 40 fewer planes. But, if they want to get to their 2026 targets, they're still going to have to take delivery on that. And that's dependent on Boeing, and we all know what is happening there these days.
Yeah, definitely. I mean, we see that they're planning on CapEx going further out to 2025 to 2027, still at $7 to $9 billion per year. But how much faith can we have in a forecast that far out at this point?
Look, there is a shortage of planes. There's no doubt about it. And it's not something that Airbus can just fill. Capacity takes a long time, to add. And Boeing's issues, predate the pandemic. They would have run into this situation had it not been for the 737 MAX crashes that they had in 2018. It's just manifesting itself right now that they can't deliver all these planes. So, we've seen the value of existing aircraft and engines go up, as a result. So one area that our experts have pointed us to have been, leasing, that they do have pricing power there. But look, United is still going to need these planes, and that's why they're just pushing out CapEx. If there's one thing we've learned from the pandemic, people still want to travel by air. And arguably it's come back even stronger. Business is a little different. It's a smaller part of the top line, but still important for profits. But passengers do want to travel, and that's what we're seeing.
And Peter, another issue here, the FAA increasing oversight. Peter, after these series of, look at a headline, making mishaps, any kind of line of sight into what comes next there?
It's just more scrutiny from the government all over this industry, right? And it's not just United and Boeing. I mean, there have been lots of things around the mergers and financings that are going on here. So it's frankly just a fact. It's a regulated business anyway. There are issues with air traffic controllers as well. It's not making it any easier to be an airline, these days. The underlying, the positive thing here, as we said earlier, it's just people want to travel. And you're seeing healthy demand. Pricing, is actually firming now because we can't get enough of these planes. But the government's likely going to slow down the amount of capacity that, that's available to consumers.
Peter, we know that United and Alaska are sort of the most exposed to the Boeing issues. Do you think that, if you're looking at buying an airline stock in this environment, do you think that others like Delta, for example, would be better positioned?
I mean, of the big ones, right? I mean, Delta has got the best balance sheet. It's a diverse fleet. And maybe most importantly, having their own MRO business, the maintenance, repair, and overhaul business, in-house, makes a difference in keeping planes in the air. We haven't seen a whole lot of issues with aircraft that's, been in the fleet, for a while. It's these new planes where these problems are coming up, whether they get delivered or, the issue that we had with Alaska back in January was on a new delivery. So that's where the challenge is, and that's not the challenge that Delta is facing. So it's a bit of a unique situation, right? United has the most ambitious growth plans of anyone, and long term they're probably going to be right that the demand is there, but they're really tied to Boeing. American, they kind of fall in between. Southwest has been more of an operational struggle, particularly around IT. They're addressing it, And they too, like United, have taken down their delivery forecast of new Boeing planes. Their existing ones are running fine, but that's kind of how we see the sector playing out.
Peter, what are jet fuel costs doing right now, and how are the airlines and your coverage universe navigating that?
Well, they're on the rise. The oil market has gotten tighter, or at least the expectations are that the oil market is getting tighter in the months ahead. We've seen inventories rise, through the winter, but OPEC stepped in and, extended cuts. And as we look to stronger seasonal demand, it's not just air travel, but it's, summer driving season and things like that. It's going to be a tighter market for oil, and that's going to flow through to jet fuel. Now, are prices likely to run away like we saw 2 summers ago? Highly unlikely. U.S. production continues to grow. We have refining capacity. Delta, again, they have their own, refinery down there in Pennsylvania that offsets some of this. But it is another kind of headwind, I would say, in the summer season for the airlines. But again, the demand is there.
Peter, thanks so much for your perspective. Really appreciate it.
Here.
There's another stock we have to check on right now. That is Trump Media. Those shares are slid again in today's session, down 14%. The company did announce that its Truth Social app would be launching a live TV streaming platform, but that did not stem the declines in the shares. The plunge, the latest in a recent string of declines for the stock. It's down nearly 40% in the past week. And by the way, the backdrop for this, jury selection for the trial of Donald Trump on hush money payment charges. Of course, he's Trump Media's largest shareholder. That is underway. 6 jurors, by the way, thus far have been selected, which is actually more quickly than had been anticipated. It was thought that it would take weeks and weeks. So the fact that half of them are already selected, maybe it'll be a little bit quicker.
The streaming platform is interesting to me too. So apparently they said Julie going to start scaling up their own content delivery network. Apparently the content's going to focus on live TV, news, documentaries, which is interesting because as we know, streaming, it isn't cheap. In fact, most streamers are they got religion on cost cutting and improving productivity. So we'll see. Stock hit a post-merger closing peak on March 27th, but a sharp, hard fall since then.
Yeah, and as you say, streaming is not cheap, and they're losing money.
Yeah. Not a good combo.
Already, yeah.
Time now for what to watch Wednesday, April 17th. Boeing safety crisis heading to Capitol Hill. Whistleblowers set to testify in front of a Senate subcommittee tomorrow about manufacturing shortcuts on Boeing 777 and 787 Dreamliner jets. The whistleblower telling NBC News in an interview recorded before that hearing that all 787 jets should be grounded.
Moving over to earnings, we'll get more bank earnings tomorrow with U.S. Bancorp, Citizens Financial, and Discover Financial Services. U.S. Bank announcing first quarter results for 2024. One analyst noting that they're expecting a drop in net interest income. That's a trend that we've seen with many of the banks so far this season. And also reporting tomorrow, IBM, Abbott Laboratories, Prologis, and Las Vegas Sands.
And finally, Volkswagen workers at a plant in Chattanooga, Tennessee, will start voting on whether to organize with the United Auto Workers Union. Vote could give the UAW its first major win outside of the Big Three in Detroit. Automakers General Motors, Ford, and Chrysler's parent, Stellantis.
And that does it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. We've got more Yahoo Finance on the other side. Energy stocks have led the way on Wall Street this year amid strong demand and production levels. Our next guest leads a key player in the sector, Noble Energy. It's a leader in the offshore drilling industry. Joining us now, Robert Eifler, Noble Corporation CEO and President, fresh off ringing the closing bell at the New York Stock Exchange to celebrate the company's 100th anniversary. There he was just about a half hour ago. Robert, thanks for being here. You know, we have been talking a lot about rising oil prices and how that affects both the industry and American spending. But when you're talking about offshore drilling rigs where you're signing long-term contracts, what's the relationship between the price of oil and the money that you guys make?
It's a great question. It's actually, I'm glad you asked it because it is sometimes misunderstood. Of course, through the long run, our activity is driven by oil price, but I would say that probably our stock trades more correlated to short-term oil price moves perhaps than it should, because our business is a long-term business. And in the offshore market, our customers are making decades-long plans, and normally short-term moves in oil price don't affect our specific service as quickly as some think.
And Robert, you know, for a period of time, their oil companies were very focused, obviously, on kind of lower cost U.S. shale. Has that shifted? I mean, how is the business of deep water drilling going right now?
Yeah, well, the offshore business has changed dramatically since just a few short years ago, and the market is actually in a really good shape right now. Our customers' spending has gone up sequentially for several years in a row now, and their forward plans, which we call in industry jargon FIDs, look to be going up for the next several years as well, which should drive several years of spending for our services. During the shale boom, our customers were highly focused on the short cycle nature of shale plays. I think during that time, there were certain customers that would have liked to drill more offshore than they did. And that created a little bit of a backlog for our services as we've come out of COVID. And I think our customers are now taking a bit of a longer term view of drilling and production. We're seeing some longer term planning, which has really driven activity in our sector.
And talk to us a little bit more short term, I guess, or if this year, next 12 months, middle term, call it. Because although I mentioned that energy stocks are up this year, shares of Noble are in fact not. They're down about 2%. You guys came out with perhaps an outlook for the year that had been below what some analysts have been looking for. So talk to me about how this year is going to look for you guys.
Yeah, so this year's a little bit interesting. We have perhaps lost in some of that is that we have a very strong year in front of us. We produced a little bit over $800 million of EBITDA last year, and our guidance this year is right around $1 billion. So we are up sequentially. But really importantly, what we've guided on our last earnings call is an exit year run rate of somewhere from $1.2 to $1.4 billion of EBITDA. And that's kind of following the shape of the ramp up in the offshore market. It is this year a little bit nonlinear, however. We've got a little bit of white space, unoccupied space on some of our assets that we're working through the middle of this year. And that's probably slightly below where some of the analyst reports were. I like to keep people focused on where we've come from and where we're headed. Which is really a tremendous ramp up in activity for our services. And obviously that's coming through in rising EBITDA year on year.
I'm just curious, Robert, how much does it cost to build a new rig? And how long does it take? And how long a contract do you need to generate meaningful returns?
Yeah, well, it's actually, you've asked probably the perfect question because that hits at kind of the heart of what I think is interesting for investors in our stock right now. We've come off of a major build cycle in kind of the 2010 through 2014, 2015 era. And at this point, there is no new build supply in sight. No one's really priced a new build rig. What we like to say is that a new build drill ship would probably cost at least $750 million to build. Some people use $1 billion. We don't really know because we haven't priced it. But we would need a contract of at least $600,000 to $650,000 per day for at least 10 years in order to support that type of investment. And it would take about 4 years to build that rig. So really what you're looking at is about a 14 to 15 year horizon of a belief in day rates of $600,000 or $650,000 a day or higher. And that's against a market today, which is perhaps just below $500,000 a day with an average contracted term of just about a year, maybe just over a year. So there's a big discrepancy between new build economics and where we are today. That said, we have a dividend. We're producing a great deal of cash. We've got, I think, the best cash flow in the business. And so at these types of economics, we can make money for our shareholders and continue to provide a great service for our customers.
And you guys are I think the third largest fleet is what you all own right now. You've done that in part by not just building your own rigs, but acquiring other companies that owned fleets. Are you done with acquisitions for now?
Well, we are just closing the books on the integration from our transformative merger with Maersk Drilling, which we closed in late 2022. And so we're proud to say that integration has gone extremely well. We've prioritized the customer experience through all that, and we've gained a lot of operational abilities through our new scale that we didn't have before. So we're very pleased with the outcome. Where we sit today, we have, I think, the scale that we need to compete globally as we do and work for many of the largest oil companies in the world. But we'll always look for opportunities if something makes sense to our shareholders to grow. That's something that we would consider as well.
And finally, Robert, I was curious. You all have a long-term contract with Exxon off the coast of Guyana in South America. And there's a little bit of a kerfuffle, I guess you could call it right now, because Chevron is attempting to buy Hess, which is Exxon's partner in that development. Exxon challenging that. Any risk for you all because of that sort of conflict that's going on?
No, not really. We have long-term contracts that are secure there. We have an excellent operating relationship with Exxon, who's the operator there. Whatever happens there below the surface of the sea, there is one of the world's greatest oil plays with some of the lowest lifting costs in the world. And with those volumes, they translate into a low carbon footprint as well. And so we're highly confident that all of those reserves will be drilled. And we're there to support our customer and continue to provide a safe and efficient operation. We see whatever possible outcome we can manage with whatever outcome comes out of this.
Robert, thank you so much for joining the show today. Appreciate your time.
It's great. Thank you very much for having me.
The Bitcoin halving event, which operates to reduce the amount of available Bitcoin in circulation once every 4 years, is projected to take place this Friday. Yahoo Finance has taken a deeper dive at what you need to know about the event. Take a listen.
The price of Bitcoin has no shortage of catalysts, from the debate around regulation to whether it's a security or a commodity and whether or not it really is digital gold. But one event is undeniable in its impact on the world's most premier digital asset, the halving. Every 4 years, the reward for mining the biggest cryptocurrency is cut in half. This happens in order to reduce the amount of coins in circulation. How is it calculated? Well, it happens specifically every time 210,000 blocks are mined. We can calculate the date fairly precisely with the knowledge that the average block time for Bitcoin mining is around 10 minutes. That calculation gets us very close to 4 years. Why is it needed? Because there's only so much Bitcoin available, 21 million to be exact. And like any other cryptocurrency, it needs to remain scarce to hold its value. So how often does this happen? Well, the halving takes place every 4 years. The first in 2012 decreased the award for creating a new block from 50 to 25 Bitcoin. The second halving in 2016, that lowered the reward further from 25 Bitcoin to 12.5 Bitcoin. Last time out, 2020. And you guessed it, we halved again. The block award dropping to 6.25 Bitcoin. So there's nothing wrong with your math here. This time around, the block reward miners will receive half, 3.125 Bitcoin. The big question, of course, what happens to the price? Now, the moves could be significant. In the past, we've seen Bitcoin rise after a halving event, though there's no certainty that this will always be the outcome. The other key focus is the outcome for the miners. The rewards that they're generating will, of course, diminish, and that's not great for an industry with a very high cost burden. Keep an eye on how the big publicly listed miners, the likes of Marathon and Riot, manage this event. As ever, talks of consolidation will no doubt do the rounds. No matter how you look at it, the event will have serious consequences for all crypto stakeholders and will be across all of the developments here at Yahoo Finance.
Elon Musk teased the arrival of a long-awaited Tesla robotaxi this August. Assuming it happens, the service will join a fleet of other companies hoping to bring driverless rides to cities worldwide. But the road so far for autonomous taxis has been far from smooth. Joining us now is Michael Wagner, CEO of Edge Case Research, a firm that helps businesses manage risk with driverless technology. Michael, it is good to see you. And maybe to start, Michael, just kind of get your top-down view of robo-taxis, because a lot of viewers, Michael, they have just been seeing these headlines of frustrated local officials, right, mishaps, accidents. They might think that kind of progress in this area has stalled. Has it, Michael?
Well, thanks for having me. It's certainly an interesting time. I think we're in the moment where the technology is good enough in order to start operating in a lot of different routes, but it's not yet good enough to operate everywhere. And so the smart moves that a lot of the technology developers are taking come in around which roads, which routes they're going to be able to take safely. So that's what we're seeing now is some calibration to be able to determine where it works and where it doesn't.
And what characterizes, Michael, where it works and where it doesn't right now?
A lot of it is simplicity, because it turns out, especially driving in a city, is very complicated. You have to understand the context of what other pedestrians and what other cars are doing. And so typically the simpler the route is, the easier and the safer it's going to be for these robo-taxis.
And Michael, I'm interested just to dig in some names. As we noted, Tesla going to host this robo-taxi event in August. What would you expect to see there, Michael?
Well, they're obviously being quite aggressive in being able to roll out this technology, and they do have a whole lot of data that they can use in order to calibrate and validate their systems. I think what I would really love to see in that kind of event is what's called a safety case, which is a structured argument for why the technology is ready to go out into the road. We have standards that are written like UL 4600 that they could use to be able to argue that very effectively to the public and to regulators.
Do you think that companies like Tesla have done a good job managing expectations around what autonomous driving is currently capable of and the timeline for when it's going to be capable of doing more?
So I think there's a variation in how well the companies have done. I run a startup company myself, and I understand that we need to be bullish about the future and paint a picture that shows where the technology could end up. So I understand that these startups need to do something like that. However, it's very complicated to explain to the general public what makes a driving test difficult and what makes it easy. Sometimes it's very unintuitive, and that communication challenge is a challenge. But I think as we start to see safe demonstrations from some of the players, we start to see smooth operations and get some public testimonials out there, as well as communication with states and municipalities. We're going to start to really get that communication down.
And Michael, I just want to get your take on GM's self-driving unit Cruise. Mike, of course, grounded their fleet last year after an accident. It sounds like they're resuming testing in Phoenix. New management team. What does Cruise's future look like, Michael?
Well, obviously, this is a big point where it could go in a very positive direction or in a negative direction. The good news is that they've brought in a very strong management team, and so I'm definitely rooting for them. That team understands some of the technical solutions that they can follow in order to get their tech out there safely. For example, doing a lot of data analysis with safe, sort of manually driven vehicles to understand the routes that they're maybe thinking about taking now in Phoenix. So I certainly am rooting for them and hoping that they'll succeed. But again, the key to this is going to be strong safety culture. Can they transform that safety culture and set up a transparent communication about where they stand?
So, Michael, to finish, sort of zooming back out here, what do you think is the realistic timeline for when? I don't even know what the tipping point would be. So I guess tell us what the tipping point would be and when do you think we'll get there?
Well, we've talked to date a lot about robo-taxis, okay? So I think that application is going to be quite incremental. If you look at what a lot of the public companies in this space are doing, they're saying that robo-taxi proliferation commercially will take a few more years. I think much sooner than that, we're going to see self-driving trucks out on highways. Those operations are planned for the end of 2024, and there's obviously a great economic incentive to get that working. So I think we're going to see trucks first, and then we're going to see some more scale on robotaxis in 2 to 3 year time frame.
And Michael, when you look at the big players right now, Alphabet, GM, Amazon, do one of those players, in your opinion, Michael, have competitive advantages that the others don't?
Well, several of them have been, in this space for quite some time. Waymo, I think, would be, acknowledged by many as having a really strong technology, a lot of provenance behind that technology, but a lot of this is frontier tech. And so, it could even be a smaller player that's going to get out there and make some technological advancement that's going to open up a new route.
Michael, thanks so much for your perspective. Really appreciate it.
Thank you.
Coming up, electric vehicles are becoming an increasingly partisan issue ahead of the presidential election, but there is one topic on which Biden and Trump both agree. We'll tell you what it is next.
Yahoo Finance's wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
The Biden administration's 2024 trade agenda pulled into focus as U.S. Trade Chief Katherine Tai testifies before Congress this week. Among the trade topics on the table are U.S. restrictions on Chinese electric vehicles. Here with more on where the U.S.-China EV competition stands, let's get to Yahoo Finance's Praz Subramanian and Rick Newman. Praz, let's start with you. So possibility maybe of new tariffs on Chinese EV makers. Where would that sort of lead the auto space?
So currently there's a 27.5% tariff on Chinese vehicles, and there's talk of reducing it or expanding it, or who knows what'll happen through these negotiations. But if it stays the same, it's good for domestic automakers. It's protecting them right now from potential Chinese competition. But right now we haven't seen the Chinese automakers here yet. They're not talking about that. I think Akiko Fujita spoke to BYD's U.S. head, and they said they were not planning at all to come to the U.S. The regular traditional consumer market. And they do have some industrial vehicles. So they're not going to do that just quite yet. If they do, a number of automakers have told me tariffs aren't going to help because they're already so cheap. Even with your 30% tariff, the car is still competitively priced. If and when they do come, it's going to be a problem. Like you said before, is there an optics issue? Would Americans not necessarily buy these cars?
I was interested to get your take on that, Professor. Even if American consumers had the choice to buy a Chinese EV, would they?
I think they might, given a competitive feature set, good price, availability. I think that cheap thing is really a big driver there.
Yeah. And cheap beats geopolitics.
Yeah, I think so. And Rick can talk about this, but legacy automakers, I think they know they got to change. If they don't, they can't be competitive with their second-gen vehicles. It's going to be a problem.
So, Rick, I'm curious how a presidency under Biden or Trump would affect trade restrictions on the Chinese electric vehicles. As we mentioned, there's already a tariff. Doesn't seem like it, obviously it hasn't gone anywhere under President Biden.
Right. So Biden left all of the Trump tariffs in place. Notably, he repealed a lot of the Trump tariffs on other countries, including Europe, Canada, things like that. But he has left literally all of Trump's tariffs on China in place. And I think this is an issue that is going to arrive sooner or later. I think this is inevitable. And I'm not sure it's even just electric vehicles. It's all automobiles. Remember, the price of cars skyrocketed during COVID, and it's still up there. It's around $48,000 what people pay for a new car on average. And we don't have enough cheap electric vehicles, but we don't have enough cheap vehicles, period. We saw this during COVID when everybody moved into the used car market, and those cars skyrocketed because people couldn't afford a new car. So what's going to happen here? We learned from the Trump presidency that a president can unilaterally impose tariffs. There has to be some procedures. You have to have certain findings at the Department of Commerce or other parts of the government. But a president can do it. And given everything we have done to support the automobile industry in the United States, don't forget it. You could say it actually started with the bailouts for General Motors and Chrysler all the way back in 2008 and 2009. Those companies were too big to fail and too essential to the economy. And then Biden, of course, sided with the auto workers during the strike last year. One way or another, the gates are going to go up to make sure these cheap Chinese imports don't get here.
Yeah, well, we'll count on you guys to keep us on top of it. Pross and Rick, appreciate it.
See ya.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.